So I'm Ashok. I'm going to talk about the coffee trade. I'm standing in for Amit, who wasn't able to be here. Okay. And coincidentally, we work on similar topics. Okay.
Not coincidentally.
Yeah, okay, that's right. Okay, you're right. Okay. Not coincidentally.
By design.
By design, yes. Okay. So thank you for having me and for staying so long, right till the very end. So coffee is grown in the tropics. It's grown in tropical highlands in beautiful places like that. It is consumed largely in the U.S., Europe, Canada, Japan. It's consumed. It's produced in rather poor countries. So if you can imagine, the belt includes Nicaragua, Burundi, Ethiopia, East Timor. You know, the tropical belt of coffee producers, as well as some not so poor countries, like Indonesia. Okay. So there's enormous potential for global reduction of global inequality through this trade. So that's why I got interested in this. So I put on 3 questions. I'm going to these are 3 big questions. How has the trade evolved? Why are poor producers left out of the surplus? And what are some market designs that work well? And I'm going to give you some, maybe you can think of it as a sketch or some hypotheses as answers. Yeah? So, okay. So the problem that I'm interested in is this problem of trust, but across cultures. So if you're familiar with Grives Maghribi traders, those are traders who share a culture, so it's intra-cultural trade. I'm interested in how do you trade with somebody who's very different from you, right? So don't share language, religion, so on and so forth, racial differences, so on and so forth. So if you want to think about the trust game at the back of your mind, and they're the standard kind of trust problems that I think are worse in these global trades. How do you ensure the seller delivers at the time, specific quality? If you have trade credit, how do you enforce that? And problems like how do you make sure that even the problems could be both-sided, so you might also be concerned about how to make sure the buyer pays. Okay, so coffee is the case study here. I'm going to hold the commodity fixed, but I'm going to vary the trading mechanism across time and place. Okay, and I think there's some more general market design issues that might apply to other global trades, which are informally enforced, so no legal mechanisms, and are across cultures. Okay, so let me tell you what I'm going to do. I'm going to try and make 3 points. So the first point I'm going to make is about middlemen, and it's a kind of a different way of thinking about middlemen. That's in the literature. I'm going to think about middlemen as solving this cultural distrust problem, and I'm going to give you some examples from the last 400-500 years of coffee trade for that. Okay. Then I'm going to talk about some field work in Nicaragua and Costa Rica, which indicates that certain farmers are left out of the gains, the global coffee market gains, the specialty market gains. And then I'm going to talk a little bit about some practical auction design. There are auctions to sell coffee in particular countries. Okay? So this is related to all sorts of stuff. Guiso, Sapienza, Zingales have a nice paper on predicting within European trade based on cultural difference and historical closeness. Firshman and Gnisi have this lovely experiment on discrimination in Israeli Jewish society, discrimination against Eastern Jews, and they talk about stereotypes, right? So you discriminate against people in a trust game whom you don't know, and you might have stereotypes about them. So there's a large literature on middlemen, but it's and Sujata and Dilip have empirical work on this too, but it's really focused. The view of middlemen in the literature is middlemen overcome search frictions. And I'm going to say a little more about what I think middlemen do. And there's a literature on enforcement problem in global trade, and Machiavello and co-authors, including Amit, have a series of papers on coffee relationships and how difficult they are to maintain. And yeah, so those are some examples. Okay, so let me start with sort of the first coffee trade. So, or at least the first cross-cultural coffee trade. So, so coffee in the 16th century was a Sufi Muslim drink. It's a Muslim drink. The first coffee shops, coffee houses, were in Yemen and then in Mecca and Medina, right? And Europeans didn't know very much about coffee, so this Dutch guy, Van den Broek, so I've been reading his diary, it's kind of fun, arrives in Mocha in 1616. And he, Mocha is at the mouth of the Red Sea and a center of Europe-Asia trade. And he goes in for this very delicate, he's part of the VOC, the Dutch East India Company. He goes in for this very delicate trade negotiation where he's trying to set up a trading post. And it's tricky because the Pasha says, no, you're going to get too close to Mecca, we can't have you here. And but he does give him a little bit of a tariff reduction. Normally traders pay 5%, but because Van den Broek financed with a ship full of cannons financed by the Dutch East India Company is so heavily armed, he gets a lower rate, right? So that's like an early cross-cultural encounter. And Van den Broek says, oh, it's really interesting, among other things these people do, is they drink this black water. Yeah? He doesn't buy any coffee on this trade. Okay? So for all of the 17th century, coffee was just grown by Arabs in Mocha. That's why it's called coffee Arabica. And by the early 18th century, there were British and Dutch factories or warehouses in Mocha. So here's another diary from 1723, which is full of incentive problems. So the problem is, so there's an English East India Company fellow who shows up, and he's trying to buy coffee to fill a ship. There are problems both ways. He cheats local farmers by misweighing the coffee. He uses, and this is going to come up again, he uses Indians as middlemen who already have trade connections with the Yemenis. And as he's trying to leave with his ship, he's held up by the governor. So the governor says, pay me more tax, and so on and so forth. And you can't go until I pay you more tax, right? So I think of this as stage one on international cross-cultural trade. It's kind of like warship trade. And it's hard, it's really hard, right? So, and if you're being held up by the local ruler, then I think of stage two as you just put the local ruler on your payroll, okay? So in the 19th century, this is like short history of coffee. In the 19th century, coffee was grown primarily, a big export area for coffee was Java. And the Dutch basically hired these local princes as middlemen and gave them bonuses if their farmers started growing coffee, which was an imported crop, instead of rice. Okay? So I want to think of the problem as, how do you trade with somebody who's very far away from you? So Michael's going to be my European today, right? So Michael's trying to trade with somebody who's like across the seas, who's really far away from you, right? Maybe he's trying to trade with Seema. Okay, can you be my native? Is that okay? Okay. Okay. So he's trying to trade with somebody really far away, and so I think a middleman is solving this problem, or even a middleman firm is solving this problem, as they're sort of double agents. So in one, they can look on one side, and they have some kind of trust on that side, and then they turn around and they look on the other side, and they have some kind of trust on that side, right? It's a very special person who gets to become a middleman, right? And in Java in the 19th century, this middleman combine was the colonial official who was looking out at the Netherlands, And he was in a combine with the local prince. It's kind of the local chief who had local enforcement power. Okay? So that's one way to grow coffee in a foreign place. Is this mechanism? Kenyan colonialism is a little different because you don't force cultivation. You grab land, and the middleman over there are white settlers who again are trusted on both sides.
Sorry, but Java was under colonial occupation at that time.
Under the Dutch, yes.
I see.
Right, so I'm thinking of middlemen kind of generally, and in my first example, the middleman was these Indian middlemen who could turn both sides.
But Mocha wasn't under the...
No.
Right. But
So
that's quite a big difference. Right?
there's a huge difference, right? Yeah. So this is why trade was so frustrating in the 17th century, because at least for the Europeans, right? Okay. So frustrating trade, things get a little better. So around the end of the 19th century, you saw the rise of multinationals, and the story that makes the most has the most texture on this is, so there's this French poet, Arthur Rimbaud, who inspired Bob Dylan among other things. He was a coffee trader in an eastern Ethiopian town called Harar. This is a for-profit. He was working for a for-profit company. So he goes into Harar, and so there I am trading between Michael and I'm trading between the European and the native. So he goes into Harar, and he basically tries to pass as Muslim. So he takes on a Muslim name. He wears Muslim clothes, and he basically has to, and he doesn't do this perfectly well, but he has to look both sides, right? He has to be trusted by both sides. Okay. So I actually want to think of multinationals. The multinationals developed after this as chains of middlemen, right? So there's a chain of middlemen. So you want to buy coffee, and there's this firm that basically crosses the sea, the difficulty of enforcement across cultures, and that firm starts with somebody who looks like Michael on this end and somebody who looks more like the native on the other end, right? And all the way through. Okay, so currently the coffee market has just a handful of multinationals, and in fact most commodity markets, that completely dominate the trade. 90% of the trade is handled by 4 big companies, and same with cocoa and so on and so forth. And one way I think of this as these are companies that have histories, right? They're sort of third-party enforcers, and they have histories of trading since the 19th century, and they keep those histories. And if you're a buyer, if you're a coffee roaster in the US, why would you go to anybody else? You'd go to somebody with this long history, right? So one implication of thinking about middlemen this way, as opposed to kind of more standard search cost ways that people have thought about middlemen, is it leads to implications such as, so the European wants to trade with the native. So one thing you could do is hire a firm that crosses the gap, which has some people in this side and some people in that side. Or you could basically make the native more like you, right? And that's native education, and you convert them. So you have grandfathers of, you have, several of our grandfathers were either converted or joined the elite, right? So you start reading the Bible. So that's one way to create, in Kenya, this is very salient, all these Kikuyu families whose grandfathers started reading the Bible and then moved up the administration. So in my sadder moments, I think of this global cost of middlemen, and that's what we were sort of trained to be. I was trained to be, right? This global cost of middlemen is all about, transferring goods from one culture to another, right? Okay, so that's all I have to say about middlemen. Okay, so I'm going to go on to talk about current coffee market stuff, unless there are questions. Okay. So I'm going to tell you a little bit about the coffee production process, a little interlude. And several of you drink coffee, so that's good. So it's a fruit. You pick it when it's red and ripe. You depulp the cherries. So those are the cherries. What we're drinking, you depulp the cherries. You wash and you ferment to take the mucilage off, and then you have these seeds, and that's what gets exported. So this is highly. There's a lot of variation in quality of coffee. So you've got to sort the seeds very carefully. You've got to dry. You've got to store. Then you mill it to take that layer of parchment off. And essentially, my sense of the world coffee market is there's kind of the bulk coffee market that trades at a fluctuating New York price, commodity exchange price. So the price moves anywhere between $3 and $1. In fact, it's dropped again very recently. It's very low, right? So that's a bulk coffee. And then there's a specialty coffee, which is higher grade. Often, I'm going to call it relationship coffee, but it's higher grade, and the specialty coffee gets paid a fixed price often, or gets paid a price premium, right? And if you want to, so the issue is going to be how do you enter the specialty coffee market? So in Nicaraguan coffee villages, for instance, there are actually two multinationals very prevalent in Nicaragua, and the multinationals are competing for bulk coffee, and they're all buying coffee at this spot market price that's determined through the New York Commodity Exchange, very competitively determined. And so farmers who sell bulk coffee sell it on the spot market. They take on a lot of price risk. And then there are a few farmers who are richer, typically larger, and they have some price insurance, they have some credit, and they also have some quality investments. So there are a bunch of non-convexities to enter into this specialty coffee relationship. So you need to be trusted. You need to be trusted across cultures. You need to be trusted, in this case, by the multinational. So one non-convexity is you need a container. At least you need to be able to fill a container. It's really problematic to mix your coffee with somebody else's and sell a partial container. And often these big firms like Starbucks would like a certification that you've been following. They might or might not monitor this, but a certification that you've been following certain kinds of good practices, right? And most importantly, and Machiavello and Moharia have a paper on this, you need a commitment not to side sell. So if you, so that's why I'll go back to this picture. Where's my picture? So if you have a price that's high, like around $3, then and it's a fixed price, a higher fixed price contract, then you see there's going to be no, and you're selling specialty coffee, there's going to be no incentive to sell in the bulk market, right? So that's how you jump out of the bulk market. Okay. So several of these multinational companies have very low cost of capital, and they can also hedge on the. They hedge their price risk, and one thing I was always puzzled by is why don't they just pass this on to their farmers? And they do to the farmers they're in relationships with. So I want to think of. So it's sort of like our standard intermediated and unintermediated sector models. There's a bunch of farmers global coffee farmers in the unintermediated, low-quality bulk sector. And then there's some who are in relationships, often with the multinationals, who've jumped up to a much higher price, right? So I think more empirical work over here would be great. Okay. So this is the bitter taste of credit constraints. So the thing is that you pick coffee, and if at harvest time or just before harvest you really need to eat, and if you pick a little early, then that lowers the quality of your bulk coffee, but it's all sold at basically the same price, so you pick a little early, right? So those green little things, those are the unripe coffee, right? So they're very simple they're simple financial interventions that could really help, but distrust gets in the way.
Is that like a grading of the commodities problem? Because for any discount rate, if bitter coffee fetches the same as non-bitter coffee, won't you pick early? Like if the commodities said we're going to test whether these beans were picked too, commodities exchange said we tested these beans, these were picked too early, there's going to be a discount for them.
Yes.
Then maybe the farmer would have some trade-off and credit would make sense. But until there's actually gradation penalty for having bitter coffee.
So yeah, I should have said that better. There is gradation penalty for having bitter coffee, right? Yes. Okay. So you might think that cooperatives could help solve the problem. Small farmers are on the spot market. They produce low quality. They have little credit risk. Why don't they band together as cooperatives? But the problem if you're a small farmer is that the cooperative adds another agency layer. So cooperative management has incentive problems as well. And cooperatives can get small fair trade premiums for selling their coffee, but those premiums arrive late. They arrive after harvest. They don't arrive as at the time of investment. Okay. Okay. So and Dejoindre, McIntosh, Tadoulet have some very nice work on how on fair trade and why free entry into fair trade can eat away at insurance. But essentially, if you talk to coffee buyers, they'd much rather deal with an estate because they don't have to deal with a cooperative that in turn is dealing with all these farmers who might be side selling on the local spot market and not supplying to the cooperative, right? That's the incentive problem. So I'm going to put up a counterexample to all this. There are cooperatives in the Tarazu region of Costa Rica that are very successful. They sell very high quality coffee at $3 a pound. They're sheltered from the world price fluctuations. And I think it's because of Tarazu's microclimate. And it's also because Costa Rica has all these great processing regulations and much better financial access. So in some ways, the best place to buy Ethiopian-style processed rustic coffee at this moment in time happens to be Costa Rica. 5?
20.
Oh my gosh, that's lots of time. Good. Okay. So I've talked about this intermediated sector and this unintermediated sector, and I want to talk a little bit about two kinds of auctions, two countries that run auctions to in some ways improve their spot market trade. Okay. So here's the first one. So the problem with spot markets is that you could be selling your coffee, Sean, and it might actually be fairly good coffee. It might be at high altitude, purely from the microclimate point of view. But because you're not in any relationship trade with the multinational, you're just selling your coffee at a low price. Yeah? And the multinationals buying this coffee, they're sorting it out, and then they're actually getting a lot for Sean's coffee just because they got lucky. But Sean hasn't found the right buyer. So the standard solution to this is to sell your coffee in auctions. And the Ethiopian Commodity Exchange does this. So in the Ethiopian Commodity Exchange, farmers sell their coffee to, essentially I'm going to call them marketers, who go to the Ethiopian Commodity Exchange. That's not exactly how it works. Farmers deposit their coffee in warehouses. People from the Ethiopian Commodity Exchange grade all this coffee in warehouses based on region and based on grade. So Sidamo 1, 2, 3 are coffee from the Sidamo region, grade 1, 2, and 3. And then these ECX people run an auction which matches buyers and sellers of this coffee. Okay? But the buyers don't see the coffee. It's like Chicago standard auctions. The buyers only see an electronic board that says Sidamo 1, 2, and 3. Okay? It's a double oral auction. They make a deal. They used to by hand. Now it's all done by computer. And this has been hailed as a really great system to sell coffee, but I don't think it is for a great market design to sell coffee. But I don't think it is because of a few reasons. One is, as you see, you've created more of a chain. So Sean's coffee goes to a grader, Ben's the grader for the ECX, and then so you've created another layer, which is a problem. And if you're in one region of Ethiopia and you're selling a particular variety of coffee, you could just as easily drive to another warehouse where you think you might get a better price. And buyers on the other side of the market are really interested in particular, especially in Ethiopia, which is really high quality specialty coffee, in the terroir of the coffee. And that can all get totally hidden through this system. So the Ethiopian system doesn't work as well as, I think, the Kenyan system. Yeah?
Sorry, but if you're selling your coffee is from terroir, why would you take it to a warehouse where its terroirness will disappear?
So some of these regions are very close to each other,
Yeah.
and you might just see a higher price for a nearby terroir. And the grader, it's hard for a grader the grader employed by the Ethiopian Commodity Exchange might not be able to tell terroirs apart in the same way as the US coffee roaster can. Right? So it's
There's something fundamental like grading can't be more granular. The fine grade, but you can say it's $1 one, you can have 2 minutes. It's just what's the limit on having those, still like the middleman, but having them have more information in how to grade it.
So I think you could give them more. You could have better grading, but the buyers really want to see their coffee and taste it because they grade it on all these dimensions. So it's hard to match what the buyers want. It's a specialty market where buyers basically can't see what they are buying.
So it's like this product attribute space is so huge, and each buyer cares about different attributes or something.
They care about different attributes, and the buyer would like coffee from Sean each year. They'd like coffee that they can trace to Sean each year, and they can sell it on their bag as single origin coffee from this particular.
But it seems like conditional on being on the Ethiopian Commodity Exchange, neither the buyers nor the sellers should care about the terroir. So if I'm a buyer, why would I go knowing that there's going to be a ton of, right? Why can't I go direct? And same with the sellers, right? If I know I have this kind of exquisite
That's right.
champagne coffee, right?
Yes.
Why would I go and have my
So I should have said that. Until recently, the government didn't allow you to go
I see,
direct.
so you're forced, okay.
You're forced to go through this.
So
You're forced to go through this
There's no-
layer that hides quality. Yes, sorry, I should have said exactly that. Yeah,
that's
uh-huh.
a bit I couldn't understand.
and only certain sellers have a way out.
That makes sense.
Yeah, it's very, very, very restrictive. And yeah.
Is that a transfer from good coffee growers to less good ones? like I'm fooling you all, so like the market would have had factor selection, but I'm making sure that bad coffee, relatively poor quality coffee roasts are getting transferred by having good coffee with theirs. Like I'm just saying there's a public policy objective.
No, I don't. I think that all the Ethiopian, it's sort of like moving Ethiopian specialty coffee, all of it down the quality ladder,
Okay.
the whole thing. So, yeah. And you're right. There is some pooling of quality, which could mean some cross subsidy, but that's not what the roasters want. Yeah. So I just want to say, in contrast, just as an auction contrast. So Kenya has these auctions where, so all these farmers or farmer estates. So Kenya has these auctions that are not where you can actually see the coffee you buy. So they have like tens of thousands of auctions each harvest season. So the week I was there were 800 lots of coffee, which, you know, the Ethiopian case has about, maybe like 60 regions and 6 categories in each region, or 4 or 5 categories in each region, right? The Kenyan coffee is much more granular, and you take it to auction. It's a double oral. It's a second price auction, a sending bid button auction. But you take your coffee from farmer A to auction. It's taken by a marketer, and there's a sample room just above the auction center where basically all the coffee in Kenya has little sample boxes or sample bags. And if you're a buyer in this auction, you can go in and sample each of these 800 coffees for a particular auction day, and you can decide how much you're willing to pay for each of those, right? So it's a lot more. Well, I'm not sure whether it's more costly, but you can then. But there's enormous incentive for quality, because you're getting paid for your particular coffee. Sean is getting paid for his very, very specific variety. The trouble with auctions is that if a coffee roaster wants to strike up a long-run dynamic sort of arrangement with Sean to invest in quality or to give him financial assistance, the auctions usually if Sean has to sell his coffee at auction, there's no way that particular coffee buyer will be able to buy it, right? So it's kind of precludes relationships, it shuts down relationships, which it makes all of Kenya into a spot market for coffee, which is pretty undesirable. But recently they've opened a second window. So the Kenyan government's opened a second window. So they allow both. So you can either go to the spot market, which is a great spot market because it's quality differentiated, or you can directly try and trade with Sean and enter into a direct trade arrangement. There are going to be intermediaries who are going to pack Sean's coffee and send it to you. But the one problem with the Kenyan arrangement, I think it's kind of a colonial leftover, is Sean can't pack his coffee into a container at his farm. He has to send it to a marketer who then takes it to auction, right? And this is just regulation. So the more people touch your coffee, the more concern about some of your coffee disappearing or it being substituted for lower quality coffee. So this is a huge issue with good quality coffee. Okay? So in Costa Rica, on the other hand, you can lock your container at source. So that's sort of like my metric of, you fill up your container, you put in all your jute or grain pro bags, fill it up, you smell the inside, make sure it's clear, and you lock it up. So that's like one advantage of the Costa Rican system. Okay?
So the justification for allowing container to be bought?
So I think it's partly so one government justification is you want people to be marketing the coffee who put up enough of a bond. Well, I'm not sure this is really much of a justification. I'm not sure why they do this. I'm not sure why they do this. I think it has to do with the fact that before independence, the marketer was the British Colonial Office, and that was a regulation that was in place. You've got to sell. You can't sell your coffee directly to the market. Yeah, so that's what I think it arises from. Okay. Okay. So. I'm done a little early, so we'll have time for questions. So, I've tried to make 3 points. One is thinking of middlemen as solving this cultural distance by racial, cultural, religious distance by having sort of these two faces. Thinking of multinationals as these firms that, in a Coasian way, incorporate sort of cross the boundary between the European and the native. Yeah. In some ways, thinking of these multinationals as they're almost like think of them almost like these law merchant, like the Milgram Weingast stuff, the law merchant kind of enforcer on these international contracts. Yeah. Then I've sort of have this conjecture that poor farmers are left out of relationship, high quality, with credit and insurance kind of relationship coffee. Relationship coffee is specialty coffee. And that's sort of the central tension in the global coffee market. And I've talked a little bit about auction design and why I like the Kenyan auctions, where you can actually see what you're buying and you can see much better incentives to invest in quality. Okay, that's all I have. Thank you. Okay, great. Yeah.
Can you talk about how hard it is to switch what you're growing from, how hard is it to adopt a new specialty and a new type of coffee? Because it sounds, stuck. How hard is it? Will you be able to go 1 year to the next growing a different type of coffee?
So you can think of the quality differences. So there are varieties of coffee. Yeah. So in Kenya, for example, the variety that's great taste is called SL28. It's developed by the Scots Labs in pre-independence Kenya, and that has really good taste. It's very susceptible to disease, and a lot of poorer farmers switch from that to a variety called Ruiru, which is a lot more resilient and lower quality. So there's a lot of switching out of SL28 to this variety, and it takes 3 to 5 years for your new coffee plants to produce. Yes.
I mean, they must have access to some credit if they're switching.
They're switching. They usually switch parts, right? So they switch just one layer. Yeah, and you see this all over the place. So there's part of the climate change problem is that coffee varieties, even so in Nicaragua, there's certain high, good tasting coffee varieties, lower yield, that are being switched out for high yield, more resilient coffee varieties because of coffee rust and so on and so forth. Yeah, but you seldom see the other way, the switch to higher, at least to the higher quality specialty varieties. It's and I think so that would be the kind of decision you'd make based on what you think the rest of the supply chain looks like, what your incentives are downstream. Yeah. Yeah.
Do you know, is there any contract farming at all?
So in the sense that, oh yes, there is. So in the sense that everything is I think everything is informally enforced. So there are big. I think of this multinational specialty coffee relationships as a kind of contract farming. So I think of this as contract farming. The richer farmers who are in these informal relationships with particular multinationals and get some insurance, they can access the world insurance market. They can hedge against the price risk, and they can get loans. I think of them as contract farming.
But they don't enter ex-ante contracts to sell a pre-specified quantity at a pre-specified price.
They are implicit ex-ante contracts, right? So this whole business, maybe I should have said this earlier, is all about securing a regular supply, right? So it's really important for these multinationals to have some people, at least, who are going to be giving them good coffee regularly year after year. In fact, it was important, like in 1723 with the British East India Company too. It was really hard for them to get a regular supply.
But so then these multinationals could go to these poor farmers and offer them credit and inputs and all of that so that they could transfer into growing the specialty coffee, right? They could, but enforcement gets in the way. So you could offer them this relationship or this contract, but at the time of this is important to say, there's 3 months or 4 months between harvest and actually getting paid. There's a 3 or 4 month coffee processing time, and the more financially constrained you are, I think, the more you'd like to sell your coffee immediately at harvest and not wait those 3 or 4 months. And it's fairly tricky for these multinational companies to trust farmers enough to get them in these relationships. And the ones they don't trust enough to make these investments, these trade credit kind of investments, are typically poorer farmers, right? They trust a few richer farmers enough to get them in these relationships. And the reason they don't trust the poorer farmers is they might make some of those quality investments or give them the trade credit, but then the poor farmer they need the money in January, not in April, so they'll go to the spot market and sell their coffee there. And Bluin and Machiavello have this paper on exactly this kind of strategic default that comes from basically side selling. Yeah. Yeah.
I'm just curious. You mentioned you're writing a book, so it sounds like there are a lot of boards and variation in regulations over how people can access markets in coffee.
Yes.
I don't know how many countries are growing coffee in the world, but I would be interested to know how costly those were, for example, in preventing farmers from entering the higher value, fair trade type markets, because we at least have some evidence that fair trade seems to be good for farmers.
So you said there are lots of what?
There's just variation in the structure. In some countries, anybody can sell coffee any way they want.
Yes.
It sounds like in a lot of other countries, you have to send it.
There's a lot of restriction, yes.
And so just understanding the costs of those various institutions would be interesting to me.
Yes. Yeah. No, I think something cross-country would be very useful. I think the fair trade premium doesn't. Maybe I didn't say enough about that. The fair trade premium doesn't work So let me tell you about the fair trade contract. The fair trade contract gives you a little premium on the coffee price. It's 20 cents, right? So that moves up and down, but it also gives you a price floor. So
DeJandre and Sadolay and Craig McIntosh have this paper about the price floors. You think the fair trade contract provides insurance to coffee farmers who, but they point out, and this is study in Central America, that the net benefits of fair trade are close to zero, because whenever prices go below the floor, like they did in 1990, way below the floor, or in 2000, the floor is $1.40. Whenever prices go below the floor, lots of cooperatives sign up for fair trade, and they pay that fee, which is per cooperative, but very few of them, but very little of their coffee actually makes it to the fair trade market, because the fair trade certified fair trade market is very tiny. So the insurance benefits of the fair trade contract are completely wiped out. So one intervention of
Quantity rationing, basically. You can't, when the price is 50 cents, your cooperative can't sell as much as they want at $1.
Exactly. Exactly, and it sells even less because lots of other people want to sell fair trade coffee at that price. So something I've wondered about actually I've thought about is this is true of other commodities too. It'd be really nice to have a kind of a hedge fund for commodities for the poor. So somebody, maybe the Gates Foundation, puts money into, or maybe even coffee roasters puts money into this fund that sort of uses the futures market and provides some kind of public insurance under really low, when there are really bad price shocks, and sort of delivers it maybe using Give directly. Yeah.
I guess your answer just made me realize I don't know what fair trade is. So it's like insurance is its main function, or?
Yes, it's a price premium. So the fair trade contract is, we'll pay you, the coffee cooperative. So there's the whole supply chain is certified, and they all have to pay little fees for certification by a fair trade organization.
Certified for doing what? Like labor practices?
For buying from cooperatives, from small farmers. Yeah, I should have said that. So the entire supply chain is certified because they buy from small farmers, and they're paid the current market price plus a little 20-cent premium. They're supposed to pay, coffee roasters or coffee buyers are supposed to pay producer cooperatives this little premium, and when if the price falls below $1.40, the world price, they're supposed to pay $1.40.
It seems like two things are being bundled that, and I guess I don't know what the goal is. Like, one is this insurance.
Yes.
That is like insurance risk, and then there's another which is trying to because I care about helping the poor, I'm like paying more to.
Yes, you're paying a little more.
Yeah, and so what? Okay. So those are just like bundled.
Those are bundled in this particular kind of contract. I should say one thing about certifications. So fair trade became kind of popular in the 1990s, and there's an international fair trade, and that only supply to cooperatives. That was only for purchase from cooperatives, and as you kind of might expect, so this is all self-monitored, self-regulated. As you might expect, a host of other certifications came up. So there's an American Fair Trade, that's a spin-off that will certify you and put a label on your coffee with some other slightly less stringent criteria. And then there's a bunch of other certifications, and Starbucks has its own coffee certification. So there's this kind of huge number of certifications, just so that every bag of coffee has something on it. And the move now is away from these certifications completely. And some people some people say they're direct traded, where they say they're direct contracts between the roaster and the farmer. And again, there's no third-party verification on this, but that's the that's like that's the cutting edge of specialty coffee now. It's these direct trade relationships, and there are few of them. This direct trade relationships without the whole middleman. Yeah.
Cool. Okay, maybe we should wrap up.
Okay. Thank you.